Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 250 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, we are deviating from our normal schedule of events to welcome Callie Cox to the show. So Callie is a market strategist who's passionate about teaching everyday investors the power of investing for their wallets and their lives. Most recently, she was the U.S. investment analyst at eToro, where she educated 2 million customers about stock, crypto, and options markets through timely reports and strategic initiatives. Prior to joining eToro, Callie worked at Ally Invest, LPL Financial, TAB or TABB Group, and Bloomberg. Her work has been featured on CNBC, Bloomberg, and the Financial Times, Yahoo Finance, and Barron's, among other publications. And she frequently shares market analysis on Twitter at Callie Boast. I hope I pronounced that right, Callie. But obviously, we get most of your work from Twitter or X, whatever you want to call it right now. So super happy to have you on the show, and welcome to the Independent Advisors Podcast.
Thank you, Mark. It's great to be here. I'm excited to chat everything markets and money.
Yeah, us too. So before we get started, we do have a great list of topics to discuss over the next 30 or 40 minutes, but we will quickly review the year-to-date performance of the major market indices that we track. This data is from YCharts, and as of the market close on May 1st. S&P 500 index is up 5.2% for the year. Dow Jones Industrial Average up 0.6% for the year. NASDAQ Composite Index up 4%. The Russell 2000 Small Cap Index down 2.2%. And the Vanguard All World ex-United States ETF up 1.8%. 3-month Treasury rate at 5.46%, 2-year Treasury rate at 4.96%, and the 10-year Treasury rate at 4.63%. So before we really hop into things, Callie, love to give our listeners a little bit more context about your journey and expertise in our world here. So if you just want to add a little more color about your professional background and kind of how you got to where you are today, in addition to the bio.
Yeah, I'd love to do that, especially because I think I have an interesting path into finance. I'm not a finance person by trade. I didn't study business in college. I actually took an intro to economics class my freshman year and hated it and promised myself I would never get back into anything involving economics again. And look where I am now. But I am a writer by trade. I went to the journalism school at UNC. My first job out of college was a reporter job at Bloomberg, where I covered option markets, but stock markets broadly as well. And one thing that I loved doing at Bloomberg was finding the story within the data. So when you think of a reporter, you think of somebody who, interviews a bunch of sources and they write these big trend pieces about what's happening in the world. And that's correct for 90% of journalists out there. I had a very different job at Bloomberg, and I actually really liked it. I wrote this daily options column for Bloomberg that was available to terminal clients only, and it was all about implied volatilities or pricing in the options market and where there were dislocations or interesting moves. And it was geared toward traders, showing traders where the opportunities were. And I loved that. I loved the focus on numbers. I still talk to many people of the options community, many analysts just like me. But in the end, the story was coming from the numbers. It wasn't coming from a lot of the interviews I was doing. So I found out I loved that, and that was like opening up my mind, because all through journalism school, I knew that I wasn't the typical reporter. I didn't want to go work for a newspaper and write trend stories on communities and things that other reporters found interesting. And the other thing I found while at Bloomberg is that I really appreciated people who taught me about markets because remember I said I'm not a business student or a finance student by trade. So I learned a lot at Bloomberg, but I can attribute a lot of that to these incredible strategists. Jim Paulson, he was at Wells Fargo. He comes to mind. John Manley, who is also coincidentally at Wells Fargo, comes to mind as well. So many strategists who taught me about markets through stories, through analogies. And I really am, a strategist by experience. So, I attribute a lot to them. And the reason why I say this is because once I got out of Bloomberg, once I started working in research, I wanted to be one of those strategists who could teach people so well and so effectively through the power of storytelling. And that got me to where I am now. Like you said, most recently, I was at eToro. I was the head of US research effectively, talking to 2 million customers within the US and thinking about strategic and interesting ways to teach them about markets, not just providing them information on what's going on. I certainly did that, but giving them the context they needed to make the best decisions for their portfolios.
That's
Yeah,
why
that's
we
great.
reference you
And
so much, Callie, on the podcast. The way that you kind of find those stories, present the data in a context that's digestible and understandable for the average investor is, I think, is a very unique trait that very few people have, and you're one of those individuals.
Yeah, I so appreciate that. And that's ultimately where I think my niche is. I call myself a strategist. I think that's the walkiest title ever. When I say I'm a strategist to my friends, they're like, okay, say more. Tell me
What does that
a
What does
little
that
bit more
mean?
about what you do. What does that
Mark and
mean?
I get
But
that, but the average person doesn't get that.
exactly, exactly. But I don't want to be like the average strategist. I want to be able to speak to the everyday investor because most importantly, I'm an everyday investor too. I'm learning it as I go. And I love delving into how we think about money and how our experiences shape, how we digest headlines and what's going on in markets. So I want to be the type of Wall Street analyst that other people can use. And, that's been my main goal since I really got into research.
Well, Callie, that really sets up the series of questions that Mark and I have planned for you perfectly because, our average listeners are looking for an understanding of what's going on in the financial markets and how it applies to them in more, layman's terms, common language rather than, getting stuck up in sophisticated investment terms, correct? So let's just start big picture, Callie. You often discuss a lot of investing themes historically. Could you share with our listeners some of those key themes that you're currently monitoring in the market and how you believe they might shape investment strategies in the near future?
Yeah, so I think we have to preface this with what actually matters for most investors, considering the fact that most investors are those long-term investors who are investing money just to build wealth,
Yep.
to, build that nest egg, save for retirement, buy that beach house decades down the road. And I also want to preface this with I don't normally sound like this. I'm a bit nasally because I'm getting over a head cold. So as I'm talking, I realize I sound a little wonky, but this isn't normal me. But in talking about, what most investors care about, you essentially have to think about four buckets, or I'll say three buckets and one unofficial bucket that I'll explain: your income, your assets, your debt, and your sanity. When I say income, of course, how you're making money, the money that you invest, the money that you spend. And, when you think about that, you have to consider inflation, job market. Those are the two biggies there. Assets. What do you have within your portfolio, within your life that can help you build that wealth? Your investment portfolio, obviously, your home, other assets you have, but, I'm mainly talking about your investment portfolio. Your debt, of course, the ability to take out debt when you need it, because we all know that debt is a tool. So watching interest rates on mortgages, car loans, personal loans, credit cards, but also the ability to take out debt, the ease of you being able to go to a bank and being able to say, I need a HELOC, for example, because I want to put an addition on my home. And then the fourth bucket, which, I go back and forth about, but ultimately I think it's important, is your sanity. Caring about what keeps you up at night, what in your portfolio matters to you that you can't really explain, but it matters because we're all human.
Yep.
And there are lots of crazy things that keep us up at night that are legitimate to our own situations. So for that, I think about big positions in your portfolio. For example, like if you love Apple, if you're a big Apple investor and you own a position that you really care about, and suddenly you hear that Tim Cook is leaving, that matters to you. That might not matter to many other investors who are long-term investors in index funds, for example, but that matters a lot to you. That falls into the sanity bucket. So thinking about those key themes, there are a few things I'm watching in markets today. I'm of course watching the Fed's big balancing act. Everybody knows that
Yep.
interest rates are quite a bit higher now than they were a few years ago, and the Fed, I mean, that's the work of the Fed, pulling levers to make sure they can get inflation down without harming the job market. I'm thinking about inflation a lot. Inflation seems to be the big word over the past few years that wasn't a big deal back in the 2010s, but has suddenly become a big issue that we deal with every day in our daily lives. For that, I'm looking at CPI reports. I'm looking at core PCE reports, which I'm sure we'll talk about in a few minutes. I'm thinking about corporate America's resiliency, how U.S. companies are doing. Ultimately, a lot of us are employed by bigger US companies that are publicly traded. So they, we think a lot about us versus them, us versus businesses, but how corporate America performs affects our daily lives. And then, finally, I'm thinking about sentiment. And when I say sentiment, I mean how how investors are positioned or how investors are investing according to their expectations in the future, the market's mood in a way.
Yep.
So, to break it down a little bit more, we're seeing strong economic data, but are investors expecting strong economic data? Are they bracing for that, or are they bracing for something much worse? Because depending on that mix, you could have a market that reacts much differently to a bad headline, for example. And I told you I'm an options reporter. Sentiment is a big deal there. You talk about the
Oh yeah.
VIX all the time, which is a gauge of S&P 500 options prices. But sentiment, I think, is the big overlay to everything. It clouds how we interpret data reports and how we interpret what's going on in markets. So it's important to watch.
Well summarized, and I would give a lot of, I say, credence to your topic of, sanity or emotions, and we talk about that a lot in the podcast, Callie, because when you're thinking of a long-term investor, what can derail their plan are some of those scary headlines, and then all of a sudden they overreact short term, and it ends up affecting their longer term plan. And so Mark and I focus a lot on that topic on the podcast. I think you did a great job there. Mark?
Yeah, I think that there's a lot of people, especially when we're talking about personal financial planning that, obviously want to make the smartest decision from a financial standpoint, but they don't necessarily understand that our entire lives aren't lived in a spreadsheet, right? So even if they're doing something that's not the most optimal from an income or debt standpoint or even investing standpoint, like it's our jobs to be like, hey, that's okay as long as you realize that. But if it helps with your sanity, we want you to be in a good space, right? So I think that's a part that's not really talked about a lot in our industry that is something that we talk about a lot at our firm, because if you're not sleeping at night because of something with your investment portfolio, then we got to change something, right?
It's affecting your whole life. And I agree, it's not talked about enough, especially in the context of day to day headlines. And quite frankly, what I do, a lot of colleagues that I have, don't talk about that enough. They mention what's going on in markets, what it could mean for certain metrics. But does that matter to many investors? I would argue sanity is probably the biggest bucket, even though it's the most nebulous bucket we're talking
Right.
about.
Right, exactly, exactly. So, kind of going off of that similar question that Matt had, what do you primarily use to shape your view of the markets? We talked about, sentiment and options and volatility, but are you more looking at fundamental data and kind of economic data, or are you more on the technical side of things, looking at charts and prices, or a little bit of both?
Right. Well, I'll give you the Wall Street answer. I'm a top-down strategist, but I know that means nothing to the majority of people listening. So, what that means is I look at economic data, broadly how the economy is doing, broadly how markets are doing, broadly how corporate America is doing. And I make inferences based on that data. And I'll say too that I'm very, very objective. I like to tell people that any opinion I ever had was, surgically removed from me in J school. So I pride myself on being very attached to the data. What the data is showing me is, what I report or what I analyze, and that shapes my views on markets and how you should think about them. So, thinking about that, I look at, of course, the big economic reports, the jobs report that comes out every month. In fact, it's coming out tomorrow. The CPI reports, for example, inflation reports, like we talked about, earnings, and more importantly, the quality of earnings. So we talk about profits from corporate America all the time, but how is corporate America making money? Are they cutting costs? Are their sales going up? What is the quality of sales? Are sales going up because prices are going up, or are sales going up because you're buying more items? Taking all of that, sentiment as well, watching how much cash people are holding, what they think about the future. This was actually a really big deal around October 2022, where things felt incredibly desperate, but investors were positioned for an awful, awful worst case scenario. And the economic data showed us that the job market was still strong and the economy wasn't in a recession. I mean, that's the perfect example where you have to think about the market's mood on top of these fundamental pieces of data that I watch. So, to sum it up, I watch broader data. I'm not looking at Apple plus my. I'm so sorry.
You're
You're
doing great,
fine.
Callie. Coming over a head cold, you are doing great. And I think what you were trying to kind of insinuate there at the end is you're not looking at, I say, the details of, say, Apple's earnings as much as you're looking at, I think, the broader picture in connecting the dots through the bigger picture data, and then developing a thesis and looking through kind of the short-term moodiness of the markets. I always like to say on the podcast, the market shoots first and asks questions later. And
Correct.
you are looking through that lens, especially in a period like the fourth quarter of 2022.
Exactly. I'm not looking at markets on a company by company basis. And there is a place for that in research, but it's so hard to look at everything as one person. So typically, teams on Wall Street, you'll see that they have a macro person, somebody that looks at the broader data like me, and then they'll have a bottoms up person, somebody who looks at company to company, sector by sector data. I just focus on the broader data.
Love it. Well, let's kind of switch gears. Let's talk about the hot topic that you previewed a couple minutes ago, which is inflation, right? So this has been a consistent topic in the market. We've talked a lot about it on the podcast. I know you have had topics about this on your X account. So, some investors are expressing concerns about inflation either staying sticky, reigniting. You're hearing those. 1 2 minute reply. How do you assess the current inflationary environment? And you mentioned some of those data points earlier, like CPI. What data points do you think investors should be monitoring?
Yeah, that's a great question. I tend to look at inflation the way that the Fed looks at inflation, because ultimately that's how the market is interpreting this data.
Yep. And I
Yeah,
think one,
go ahead.
go ahead, Mark.
Go ahead. No, no, no,
Well, I
go
was going
for
to
it.
say is I think what's really interesting, Callie, to give you a second, the market is continually, it feels like, anticipating, the Fed's moves. And it feels as if the market obviously has been way off the ball, big picture, over the past 12 or 18 months. If we would have had this conversation during that time period, if someone would have said to you the ability of a soft landing was possible, you would have been laughed out of the room in Wall Street. And you fast forward to today, I think that obviously that narrative has changed. And I'll turn it back to you for your comments.
Yeah, that's exactly right. And thank you for assisting me there. Like I said, I'm talking
Of
with a head
course,
cold. So,
of course, you're
um,
doing great, and we appreciate your presence on the podcast.
yeah, and this is a really fun conversation. This is a topic that you could dig into so much. I mean, I mentioned I look at inflation the way that the Fed looks at it, but I also don't want to dismiss the fact that a lot of us experience inflation in our daily lives. I mean, we don't experience
Yep.
the way that the Fed looks at inflation. What I mean by that is the Fed cares about non-housing services inflation. Jay Powell says it pretty much every time he comes public these days.
Great point.
What that looks like is, the Fed doesn't care about oil prices. They don't care about food prices. They don't care about rent prices to a certain extent because they understand that that's inflation that they can't control through policy.
Right.
It's interesting you say that. The one thing that comes to mind, Callie, and I've referenced this on the podcast off and on over the past 12, 18 months, is this difference between the way the Fed is looking at shelter inflation and what we are seeing in the real-time rent data. And there's a lot of sources that I've referenced on the podcast in the past, like Redfin as an example. And there seems to be a lag in this data. And what I mean by that is the real-time data for some of our newer listeners is showing that, rent inflation over the past year is pretty much flat. But the data source on rent inflation is still showing mid-single digits. And I know it's lagging. Have you noticed that observation as well? And what's your thoughts on that?
Yeah, I mean, that's a great point, Matt. Powell actually mentioned this yesterday when he came out and spoke after the Fed decision. I mean, there's this nebulous part of real-time data which we have access to now because technology is incredible and we have, certain almost sources like Zillow and Redfin that we can see real-time data come through as. But then we also have the way that the government measures data. It's a bit more backward looking. It's a bit more long term. There are some really big analytical differences where eventually the government data catches up, but real time data shows us first. It's real time data, of
Yep.
course it does. But the assumption from the Fed, from many economists, is that real time rents are essentially flat right now. We're seeing that inflation is being controlled when it comes to renting. But we're not seeing that flow through into PCE data, into CPI data. And the big question mark is how long that'll take because it's already been several months of seeing real-time rents, normalize out, but
And Callie's
seeing rents
talking
be
listeners about year over year data. So the data year over year, just to give a sense.
correct, yes, which is probably the most, if I had to say in a broad term, probably the best way to look at inflation data. That changes from time to time, right? Because long-term trends tell us something, short-term trends tell us something else. So we're waiting for CPI data and PCE data to catch up to what we're seeing in real-time data. But I want to go back to this point about experiencing inflation versus understanding what inflation means for your portfolio. Going back to the inflation the Fed cares about, non-housing services inflation. That means airfare, hotel costs. That means vet visits, the cost of vet visits, the cost of manicures, the cost of insurance. A lot of things that depend on the demand from us consumers, what we spend money on, and the pricing power that these firms have because of the demand that we express for these items. Of course, inflation affects us in a number of different ways. It affects us at the pump. It affects us at grocery stores. I can attest to that. My grocery bill is a lot higher than it was a
I think
year
we all
ago.
can, Callie. And so these are all great points. I love this. Keep going.
Yeah, and it's I mean, this is all a problem and it's slowly getting solved. But when the Fed talks about inflation, they care about 55% or so of that overall CPI that we're watching, because they know that that's the part that they can affect with interest rates and with other policy tools that they
There
have.
it is, right there.
I mean, they spend money at the grocery store. They spend money on gas for their cars. They know that inflation is a pain, and in your daily lives, you're going to experience it a lot differently than how the Fed talks about it. But the Fed has a dual mandate and they stick to it very closely. They are looking to control inflation, but the inflation that they can control. And then they're looking to maximize employment. So making sure we have as strong of a job market as possible.
Well
Yeah,
said.
and it's an interesting thing too because right now the jobs market is still so strong, and what drives two-thirds of the American economy is consumer spending. So it's like,
Boom.
okay, well, if we really want to see inflation come down significantly, I guess, over the long term, from my opinion, it's like, okay, well, demand has to drop off at some point, but if demand has to drop off, then that means like unemployment probably has to rise a little bit, right? So it's like, what are we what are we rooting for here? Higher unemployment or lower prices? And that's kind of the interesting spot I think our economy is in right now, because in my opinion, the economy is kind of humming along and doing just fine. But no one ever wants to root for higher prices or higher unemployment, right?
Right, and that's usually seen as the choice, right? Because that's been the choice historically. A lot of times when inflation has spiked, the Fed has said, I mean, that makes everybody think of Volcker. I mean, Volcker said we have to hammer the economy through interest rates, and ultimately that tipped us into recession. The interesting dynamic this time around is that we don't really have to choose. We're getting our cake and we're eating it too. Inflation has come down from a 9% rate in the summer of 2022 to just above 3% now. And toward the end of last year, we saw PCE numbers that were flirting with that 2% level to the point where the Fed could have conceivably said, we're done here. We can pull back on policy and focus on the job market a little bit more. So Powell, and I think this is right, Powell attributes that a lot to supply. A lot of things were broken during COVID, supply chains, obviously, but dynamics within the job market where there were a lot of job openings, a lot of demand for goods, eventually a lot of demand for experiences in the summers of 2021, 2022, 23 even. But that demand is leveling out. We're seeing job openings come down, and we're seeing more people step into the labor market, especially immigrants, which I'd argue is a good dynamic where they're able to fill these positions, and there isn't as much as a power imbalance between employees and employers. Because of course we all love a higher paycheck, but we don't love when prices are rising higher than our paychecks. So the economy is healing, right? And it's healing without the broader economy falling into a recession. There have been pockets of pain. You see that in the housing market, you see that in certain industries like finance, like technology. But overall, we haven't had to sacrifice the whole economy. And I think that that is something to celebrate and something not to forget. I mean, that's one of the reasons why the S&P and stocks have been so strong
Hmm.
over the past year or so, because we've avoided the dreaded recession.
Right.
Callie, you're putting on a master class right now about what's going on with inflation the last couple of years. Well done. That was awesome.
Yeah, and
Yeah,
I
and
want to
I
add one more.
go ahead, Kelly.
Oh, so I want to add one more thing because I don't know how many people you'll really digest this. A healing economy isn't prices coming down. You actually don't want to see prices coming down across the board because that signals that there's something seriously wrong in the economy. That signals that there's not enough demand to, keep the economy running, to, satisfy certain companies. And that ultimately shows that we're not in a good place and you might actually lose your job because there's not enough demand. And right now, when I say the economy is healing, I mean wages on a broad scale are growing faster than prices. And that leads to a world that suddenly feels a little bit more affordable step by step. An example I like to give is I don't know how much Caesar salads are in your area or Caesar salads with chicken, but I've noticed in Charlotte, North Carolina that Caesar salads are, $10. And I, with the way that the economy works, I have to become comfortable with the fact that Caesar salads will always be $10.
That's right.
But they will feel more and more affordable as my paycheck catches up to Caesar salads. We don't see prices go down to where they were in the 80s. We never see milk at $1 a gallon, but we get to a point where we can afford it, where our budget suddenly feels a little more comfortable. And that's what we're seeing right now. We've seen that happen over the last several months. It's a slow process, but it's happening. And I think we can all feel really good about that the Fed's grand scheme here is working.
Yeah, that's a great point because I think there's a huge misconception, especially for, newer investors or people new to personal finance. They're like, I just can't wait for prices to go back to where they were. And I'm like, I'm sorry to tell you, but they're not going back to where they were. Eventually, you're going to make more money. And like you said, these things are going to fit back into your budget. But nor do we want prices to go back to where they were, because that's not a good thing either. Um, last thing I had for you, Callie, was I think a question that we get a lot from investors or people that are new to this. They're like, there are so many things that you can focus on when it comes to investing. I don't know where to spend my time. Like, what really matters for me to pay attention to? So, what is, in your opinion, one thing that you think investors spend too much time on that doesn't really matter, and one thing that investors don't spend enough time focusing on? And for example, for me, and Matt knows this, I can't stand analyst price targets because it just means nothing to me, and it gives people false hope. It's like we get people saying, oh, well, this guy at UBS has a $400 price target on Apple. We got to buy some Apple. And I'm like, oh god, I don't want to get on my soapbox, but that infuriates me, right? So what are some things in your opinion that have that same cringe effect for you?
Mark, I think you're reading my mind. uh, I would agree with you. I think people generally focus too much on predicting the future, trying to find the edge and thinking that that's the, path to this big and wonderful, wealth that they're trying to grow toward. This like fast track path, I'll put it that way.
Well
And,
said.
for some people, that's true. For a small sliver of the investor population, that happens. But for most of us, the path to wealth is a slow and, methodical approach to just building your assets over time. And it works a lot better than you realize. I mean, compounding is really hard to, you know, kind of conceptualize in your mind, right? So, I agree with you. I think price targets are more harmful than helpful for the average investor. I definitely, as a reporter, I remember compiling all the price targets, the S&P price targets off of Wall Street, and just, marveling at the fact that they were consistently wrong. Um,
Right.
a lot of them, at the beginning of the year, point toward an 8 to 10% up year, and that rarely ever happens. A
Mhm.
lot of times stocks rise a lot more than that, or they even fall during the year. But it's a marketing tactic that works. And I mean, investors and people in general are uncomfortable with uncertainties, so they gravitate toward that certainty that they're looking for. So I think you're right. Outperforming the market too. That's another uh, edge or strategy that I think people focus too much on, and that ultimately burns them in the end. I'm interested, Matt, what would you say as something that investors focus too much on?
I think they focus too much on today's headlines. I think that
Ooh.
the average investor is so long-term focused that the headlines they're seeing today are not going to impact their longer-term game plan as much as they think. And one thing I like focusing on is, every year we're going to have those two or three headlines that are going to spook someone and make them question, should I be invested in risk assets in general? Right. And so, you had really key things happen, such as, the Middle East conflict, you had the Ukrainian conflict. You go through some of these events where all of a sudden, once I hear the term, it's different this time. That's when Mark and I are usually like, okay, let's talk through this. The market's been more resilient than we think the last, especially 20 years. And that's what I think most people make mistakes, is making emotional decisions on a short-term basis for money that's already deemed to have a long-term investment objective.
Totally agree with that. And, when we talk about geopolitics and scary headlines, I feel a lot of empathy toward focusing a lot on those headlines because these are scary events. They're humanitarian crises, right?
Sure.
They, of course, evoke a lot of emotion in you because we're talking about lost lives. We're talking about a wide range of scenarios.
Absolutely.
that could happen. We're talking about a lot of uncertainty that nobody can quell through price targets or policy predictions. So if you get freaked out by these headlines, your feelings are very valid. I think the conversation there, and it's a tough conversation to have, but um, in your portfolio, what matters is the economic consequences. And for most of the conflicts we've seen recently, the economic consequences just haven't been big. Other consequences have been material, they've been massive, of course, but you have to be careful about separating what it means for your portfolio and what it means for your daily life, and understanding how to control what you can control within your portfolio. What that
Well
looks like
said,
might be,
Callie. Well said.
yeah, I don't think strategists, analysts, most people on Wall Street focus enough on how to separate out your emotions and how to learn how to honor them outside of buying or selling in your portfolio or making hasty decisions. And I think that that's a real art, that's a real practice that we're all working on. I'm working on too.
Love it.
Yeah, and I think that we've all seen the charts, right? Of it has the the chart of the S&P 500, and it has all of the geopolitical events going back the past 40 years, right? And what has the market continued to do? It's continued to make new all-time highs, and albeit it takes some time after some of these events like '07 and '08 and the tech crash and in 2001. But again, if you have that long-term mindset, you're just going to be set up for success. And I think it helps when people bucket this money, right? So it's like, okay, this bucket of money. Bucket one is something I'm not going to touch for 20 years. Okay, bucket two is like 10 to 15 years. Bucket three is maybe in the next 0 to 5 years, right? And I think if you bucket it out that way, when the market does sell off 30%, or we go through a month like March of 2020, you're not stressing about that long-term 20 plus year bucket, right? So I think that really helps if people need help rationalizing some of the things that are going on around the world at any point in time.
Yeah, that's a great tool. The other thing I tell people is that it's, and this depends from person to person, but it's usually not a bad idea to have a little bit of your money in some kind of short-term play account, for lack of a better word. So you feel like you have some control over the situation,
Mm.
but it's not so much so that you're affecting your whole long-term investment plan, through trying to feel like action will satisfy what you're feeling about a conflict. Like, great example is, with Middle East conflict, you typically see a lot of moves in oil prices because a good bit of global oil comes out of the Middle East. You also see that show up in gold prices quite frequently. We saw that in the Israeli-Iran headlines that we got a few weeks ago. And to a certain extent, it's fine to express that. It's fine to, look for the edge there, as long as you have a purpose for that in your portfolio. And it's separate from that long-term plan that many of us have.
Well said, Callie. Well, I know we're getting close to being end of time here for the podcast. Your insights, I think, are incredibly valuable to our listeners today, and I'm sure many of them would love to stay up to date on your perspectives and analysis in the future. Could you please let our audience know the best way to follow your work online?
Yeah, so you can find me at Callie A Bost, Bost, on Twitter/X. I call it Twitter. I'm one of those, old timers who will always call it Twitter because I've just been doing that for the past 10 years. But you can find me on Twitter, Callie A Bost. I also post a lot of my insights on LinkedIn. I will start posting more there in the next few months or so, but right now that channel is a little quiet. Yeah, and you'll see me pop up hopefully in the next few months or so. So I'll be excited to update everybody then.
Great.
Yeah,
Well,
I was gonna ask, are you able to drop a little hint about what we could see you doing next, or are you gonna save that for a few weeks, couple months down the road?
I wish I could because I'm so excited about what's coming next, but I'm gonna keep that under wraps for now.
Great. Well, we look forward to seeing what you're gonna do. I'll obviously be following your work a lot, and hopefully some other time we can have you back on the show to talk about the latest and greatest about what's going on in the future.
yep, we'll be tagging you. We'll be using your content in the podcast. So keep up the great content for us. It makes life easier.
Yeah, for sure. Love it. Thanks for having me.
Thanks,
Callie, you're
Callie.
the best.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.